I want to get your reaction to Jamie Dimon's comments, but specifically to this idea. We keep hearing from CEOs repeatedly who say, look, actually, our business today, not so bad. In fact, actually, maybe great. Everything looks good, except we're worried about what's going to happen 6 to 9 months from now. There's actually no signal just yet that our business is going to be worse in 6 to 9 months, but we believe it's going to be worse in 6 to 9 months. So therefore, the question is, will they be right or wrong?
Yeah, good morning. I think it's very hard to call whether they'll be right or wrong. You know, there are some signs, there's sort of two parts to this, right? There's the economy and the market. So there are some signs that the market's bottoming out. There are signs that, you see generals falling. You see this state of oversold stocks right now in the market. A third of NASDAQ value is gone. A quarter of S&P value is gone. So there is a big hit there. And I do think that has an impact on sort of people, consumers, and spending and your view of your own financial wealth. And then that feeds into the economy. So, the answer is it depends. It depends on what the Fed does. I think that if we keep seeing these aggressive rate hikes and we don't sort of pause to take in the data and to consider things like food falling, mortgages falling, rental cars, airline tickets, things like this actually happening, and we just sort of keep going, then I do think that the consumer will be impacted in 6 to 9 months from now. We will risk that recession.
Let me ask it maybe in a different way then. For those viewers who are watching Jamie Dimon talk about the prospect that the stock market could fall another 20%, right? And we've now heard that kind of idea. Paul Tudor Jones yesterday said equities were still too high. I mean, we've heard that repeatedly now. Historically, we've told investors and the financial community said, look, if you have a portfolio, it's better off you hold on to your portfolio than to sell things. You're never going to time it right. The question, though, is if you really think that there's another 20% to go, maybe you do want to be in some cash. No?
Yeah, I think it's a tough thing because you're right. A lot of people have gotten the advice like they said, hang on in there, right? So my view on this is that if we get the slight earnings recession, which seems kind of the worst case scenario to me would be like that soft to medium term landing. Banks are in good shape. Corporate America is in good shape. As you said, the numbers look pretty good. You don't have a 2008 situation on our hands. So that brings you down to like a 3,300, 3,200 level. That isn't a 20% move. I also think that if you're an investor and you sort of don't need the cash today, tomorrow or 2 years from now, if you sell now and you want to get back into the market, you're more than likely to buy at higher prices at that period of time. So it depends on who you are. If you don't need access to your cash, I would wait it out. Historically, if you look at those charts since the 1950s, a year after, say, today or so, the market bottoms out before the economy does, and you see those double-digit returns. So historically, it has almost always been the case that if you stayed in the market, you would sort of get your money back and sort of get to par.